Have you noticed this feeling? Like money doesn't feel real anymore? Prices are up, savings feel weaker, and every country keeps printing more currency like nothing will break. What if I told you the global currency system is quietly resetting, and most people won't realize it until it's too late? Today, I'll show you how I'm investing in 2026. Not with fear, but with strategy. Here's the problem most people don't see until it's already hurting them. We're taught that saving cash equals safety, like money sitting still can protect us. So people work hard, stack cash, and feel responsible. Others think if the economy crashes, they'll just wait, do nothing, and things will go back to normal. And many believe investing is a game only rich people are allowed to play. But history shows the opposite. When currencies weaken, cash doesn't disappear, it quietly shrinks. Like ice melting slowly in your hand. You don't notice day to day, but 1 year later, it buys less food, less rent, less life. This isn't about fear. It's about putting your money where it can survive. Think of money like a measuring tape you use to measure your life. Rent, food, fuel, savings, goals, everything is measured with it. Now imagine that measuring tape slowly stretching without you noticing. Suddenly the numbers look bigger, but your real progress hasn't changed. That's inflation. Governments don't wake up one day and announce a reset. Instead, they slowly increase debt, print more money to cover gaps, and let purchasing power fade quietly. On paper, things look fine. But in real life, wages stay flat while prices creep up. You work just as hard, yet life feels heavier. That's the reset. Not a collapse, but a shift. Value quietly moves away from weak assets toward strong ones. This is where cash becomes tricky. Cash feels comforting because it doesn't move. You can see it, count it, and feel in control. But that stability is an illusion. Imagine holding an ice cube in your hand. It looks solid, but it's melting the entire time. Someone who saved $10,000 in 2020 did everything right. They were disciplined. They didn't gamble. But by 2026, that same money buys 20 to 30% less. Groceries cost more. Rent eats a bigger chunk. The number stayed the same, but the value didn't. Our brains are wired to avoid change, so we cling to cash. Markets, however, reward ownership, movement, and participation. That's why wealthy people don't sit still. They reposition. So how do you position without panic? I think of it in layers. First is the foundation. Hard assets. Things that can't be printed or duplicated easily. Gold, commodities, real assets connected to production. These aren't exciting, and that's the point. You don't buy them to double your money overnight. You buy them so inflation doesn't quietly erase years of effort. It's like putting on a seatbelt. Not flashy, but essential. On top of that comes growth. Productive assets. These are things that actually create value instead of just sitting there. Strong businesses, dividend-paying companies, firms tied to energy, infrastructure, or AI, areas the world keeps needing more of. If a company can raise prices when costs rise, it protects your money automatically. While cash gets weaker, these assets adjust. They move with the system instead of being crushed by it. Then there's the small experimental layer. Asymmetric bets, high risk, high upside, but kept small on purpose. New financial systems, emerging technologies, innovation plays. Think of this like spices in a meal. A little can change everything. Too much ruins it. The rule is simple. Never risk money you need to survive. Most people either go all in chasing the next big thing or avoid risk completely. Balanced investors do neither. They prepare for the reset by spreading risk, staying calm, and letting time work in their favor. Let's make this practical, because information without action doesn't change anything. The first step is realizing that holding too much cash isn't being responsible anymore. It's being exposed. That doesn't mean emptying your bank account or taking wild risks. It simply means separating safety from growth. Start by keeping emergency money, the kind that lets you sleep at night. 3 to 6 months of expenses is a good mental target. That money isn't there to grow, it's there to protect you when life throws a surprise. Everything beyond that deserves a job, once you know what your true safety buffer is. The rest should be invested with intention, not emotion, not headlines. Intention means you understand why each dollar is placed where it is. Think of your money like a team. Cash is the goalkeeper. It just needs to stop disasters. The rest of the players are there to move the game forward. If too many are standing still, you never score. The next step is building a portfolio that can handle inflation without constant stress. That usually means mixing protection with growth instead of choosing one or the other. Protective assets help preserve purchasing power when currencies weaken. Growth assets help your money outpace rising costs over time. Imagine wearing a jacket and walking forward in the rain. The jacket keeps you dry, but moving forward is what gets you where you want to go. You need both. For beginners, this doesn't require complexity. You don't need 20 assets or daily trading. Start simple. A portion that holds value during inflation. A portion that grows with the economy, and a small portion, if you're comfortable, for higher risk opportunities. The Act percentages matter less than the discipline of sticking to a structure. Consistency beats perfection. Another powerful shift is changing how you measure time. Most people look at money in months. They ask, what will happen this year? Or what if the market drops next quarter? Currency resets don't play out in weeks. They play out over decades. When you zoom out, short-term noise becomes background sound. Market drops feel less scary. Slow growth feels normal. You stop reacting and start positioning. A simple habit that helps is regular investing. Instead of waiting for the perfect moment, you invest steadily. This removes emotion and builds confidence over time. It's like climbing a mountain step by step instead of trying to jump to the top. Small, repeated actions quietly compound. The biggest mistake people make during currency shifts is waiting for clarity. Clear signals usually come late when prices have already moved. Action comes first, comfort comes later. You don't need to be aggressive. You just need to be intentional. When you stop letting money sit idle, protect what you've earned and think. In decades instead of months, you're already ahead of most people. That's how you prepare for a reset without panic. This isn't just about money sitting in an account or numbers on a screen. Once you really understand how this system works, it starts changing how you see your entire life. You begin to realize that financial stability isn't only built through saving. It's built through flexibility. That affects the kind of career you choose. Instead of chasing titles or safe jobs, you start valuing skills that can travel with you. Skills that still matter if the economy shifts, industries change, or currencies weaken. You stop asking, is this job secure? And start asking, is this skill useful anywhere? Where you live also starts to matter in a different way. People who understand currency shifts don't automatically chase the most expensive lifestyle they can afford. They think about cost of living, opportunity, and optionality. Living somewhere affordable doesn't feel like a downgrade anymore. It feels like leverage. Lower fixed expenses give you more room to invest, take risks, or walk away from bad situations. Freedom becomes the goal, not appearances. Flexibility becomes your real asset. When your income isn't tied to just one source, you breathe differently. Someone with multiple income streams doesn't panic when one slows down. They adjust. That could mean a main job plus investing income, freelancing on the side, or building something digital that earns independently of location. It's not about doing everything at once. It's about not being trapped. Step by step, you reduce dependence on a single paycheck. This mindset also changes how you react during market crashes. Most people freeze because they've never thought beyond the moment. They see headlines, watch prices drop, and assume the worst. But someone who understands the system knows that crashes are part of the cycle. They've prepared mentally. They've kept emergency money. They haven't over-leveraged their life. So instead of panic, they see options. Maybe it's a chance to invest. Maybe it's a chance to learn. Maybe it's just a moment to stay calm while others rush. Upskilling becomes natural in this mindset. Why? Don't wait until things break to learn something new. You learn early. You add skills quietly while times are good, like reinforcing a house before the storm instead of during it. When change hits, you're already standing on stronger ground. The biggest difference you'll notice is emotional. People who don't understand this system feel controlled by money. Every change feels threatening. Every headline feels personal. But people who do understand it move differently. They're calmer. They don't need to rush or chase. While others freeze, they make small, thoughtful moves. And over time, money flows toward that calm. Not because they're lucky, but because they're prepared. Here's the truth. And it's simpler than most people expect. The global currency reset isn't some dramatic headline you'll see flashing on the news one morning. It's not a countdown clock or a single event. It's a slow, ongoing process that's already been happening in the background while people are busy with daily life. Prices rise a little. Savings feel lighter. Opportunities quietly shift. And by the time it's obvious, the advantage has already moved to those who were paying attention early. What separates the winners from everyone else isn't intelligence or insider knowledge. It's behavior. The people who come out stronger aren't guessing the future perfectly. They're preparing for multiple outcomes. They build discipline when things feel calm, not when things feel scary. They invest with intention instead of emotion. While others chase trends or freeze waiting for certainty, they take small, steady steps forward. This is important to understand because Many people think they're behind simply because they don't have a lot of money. But money isn't the starting point. Awareness is. A person with average income who understands how systems work often does better than someone with more money but no plan. You don't need millions sitting in an account. You need clarity about where value is going and the patience to align yourself with it. Think about it like steering a ship. You don't wait until you hit the storm to grab the wheel. You adjust your direction long before the waves get rough. Small changes in direction, made early, completely change where you end up. That's how this works. You protect what you earned. You give your money a job. You stop letting fear or comfort decide for you. By 2026, doing nothing isn't neutral anymore. It's a choice, and it's a risky one. Leaving money idle while currencies weaken is still a decision, even if it doesn't feel like one. Waiting for perfect certainty usually means arriving late. The people who move ahead aren't reckless, but they also aren't passive. They understand that progress comes from participation. If they shifted how you see money even slightly, that's a powerful start. Stay curious. Keep learning. Surround yourself with ideas that make you think long-term instead of react short-term. This isn't about being aggressive. It's about being deliberate. And if you want to keep thinking this way, keep sharpening your perspective and stay ahead of the noise. You already know what to do. Stay sharp. Stay patient. Because money doesn't reward hope or wishful thinking. It rewards strategy, consistency, and the courage to act before the crowd catches on.